The US government just issued 30-year bonds at the highest rate since 2001. And at first glance, you might think that means investors don't want to own US government debt anymore. But that's not actually what happened. The bond auction itself showed very strong demand, with a bid to cover ratio of nearly 2.4, which means there was almost double the amount of demand than supply for the US government debt. So investors are still very willing to lend money to the US government. They're simply demanding higher interest rates for it. And that's important because the cost of borrowing is becoming just as important as the amount we're actually borrowing. And eventually that cost gets passed down to all of us as higher borrowing costs and potentially even higher taxes. So today I want to explain what's happening in the US Treasury market and why the government's response to higher long-term rates is creating potentially another problem, and how that problem eventually circles back through the Federal Reserve, Japan, and ultimately back to the US bond market itself. But first, welcome back everyone to the Lunch Money Investing channel, where you get a math econ nerd, that's me, to break down market moving events every single week so that you can make more informed decisions for your lunch money and protect that portfolio. If this type of content sounds interesting to you, please smash that like button and consider subscribing. Anyways, let's get back to the main story. Let's jump back to the Treasury auction market I just mentioned. The US Treasury sold roughly $25 billion of 30-year bonds at a yield of roughly 5.22%. And as of August 14th, that yield is now at 5.26%. Yields have clearly broken higher. And that's not just the 30-year that's flashing warning signs. We also recently had an auction on the 10-year note. The US Treasury sold $42 billion at auction at the highest yield seen since 2007. So this isn't a one-off issue we're seeing strictly at the 30-year end of the curve. We're seeing this across the board. Borrowing costs across the long end of the US Treasury curve are rising. And that makes sense when you look at the economic backdrop here in the US and also globally. The US is running persistent enormous deficits. Debt to GDP is now at 101% according to the latest estimates, and that is projected to grow to 120% by 2036. On top of that, the government is already spending nearly 15% of its annual budget each year just to pay the interest on the debt that it currently has, which currently stands at $40 trillion. And that number is growing every single month, every single year, without showing any signs of slowing. So now, imagine you're an investor and you are being asked to lock up your money for the next 30 years. You're looking at persistent growing government deficits. You're looking at persistent sticky inflation. So given this backdrop, given this information, you're probably going to demand higher yields yourself. And that's exactly what we're seeing right now. But here's where things get interesting. The US Treasury has actually been responding to these higher long-term rates by changing where it issues the debt. And that brings us to the short end of the curve. So we talked about the long end, now let's talk about the short end. Treasury Secretary Scott Bessent is a smart guy, a really smart guy actually, if you look at his background. And he's well aware of the strain higher rates has on government finances. So the US Treasury has been leaning more and more heavily towards the short end of the curve. Long end over here, short end over here. And there's a pretty logical reason for this, right? Short-term rates in general are lower than long-term rates. When you go borrow money, it's a lot cheaper to borrow for 2-3 years than say 10 or 20 years. Anyways, by issuing more bills instead of locking in higher rates on long-term debt, the Treasury can reduce the amount of new supply hitting the long end of the curve, as well as, of course, locking in the lower rates for the next year. In other words, it's trying to take off some pressure off the long-term yields by choking the supply of bonds hitting the market there, while also taking advantage of cheaper short-term financing rates today. And that makes sense as a short-term strategy. But it also creates another problem. Treasury bills mature in 1 year or less. So when they mature, the government either has to magically find the money, or it has to go back to the bond market and refinance that debt. If rates have fallen, phenomenal. But if rates instead stay high or even go higher, the government now has to refinance that debt at those higher elevated interest rates. And this is where the Treasury short-term solution runs directly into the Federal Reserve. Because if the Fed were able to simply cut rates aggressively today, this strategy would become much less painful and would actually pay off. But the Fed simply can't slash interest rates whenever the Treasury needs cheaper financing. It still has an inflation problem to deal with. Of course, inflation has improved significantly compared to the 9% we had a few years ago, but it hasn't disappeared altogether. Just look at the latest report. July headline CPI came in at 3.4% year over year, while core CPI, the Fed's preferred measure, is at 2.5%, and core PPI was at 4.2%. So clearly, the Fed still has inflation to contend with. The Fed is stuck. If it cuts rates too aggressively, it risks allowing inflation to come roaring back. But if it keeps rates higher for longer, the Treasury continues refinancing debt at elevated rates. And because the Treasury has shifted more of its financing towards short-term debt, that higher rate environment can flow directly to the government financing costs much more quickly than before. So you've created a pretty uncomfortable, well, not you, the Federal Reserve and the Treasury have created a pretty uncomfortable situation. Treasury wants lower rates to reduce its financing costs today. However, the Fed needs to make sure inflation doesn't come roaring back. And if that wasn't complicated enough, there's another problem. And this one comes all the way from Japan. The US has maintained substantially higher interest rates than Japan for the last few years. And that creates a structural incentive for investors throughout the world to move capital toward US assets. Why lend money in Japan at relatively low interest rates when instead you can earn considerably more money by owning dollar-denominated assets? Or if you're crazy, take it one step further. Well, actually not crazy. This is actually the yen carry trade. You can take it one step further, right? You can actually borrow ultra cheap Japanese money and then take that money and go buy US assets and earn the spread. That capital flow puts pressure on the yen. And the yen has been sliding against the dollar for the past 5 years, longer actually, despite multiple intervention efforts by the BOJ. Then last month, in a surprise tag team event, the BOJ and the US Treasury both bought yen together in an attempt to turn things around. And if we look at the charts here, we see the dollar-yen exchange rate fell from roughly 164 to around 155. And for the non-forex nerds, lower means stronger yen. But anyways, now just a couple weeks later, roughly 2.5 weeks later, the yen has given back much of that move and is again testing 160. And that's a problem for Japan because a weaker yen makes imports more expensive. And Japan imports virtually all its energy. And all this translates directly into higher inflation. So the Bank of Japan has a difficult set of choices. It could, of course, do absolutely nothing and let inflation run wild. It can raise interest rates aggressively. Or it can intervene again in the currency markets. But we've seen how that's played out. And that's where the US becomes directly involved. The recent intervention was extraordinary. The US and Japan have not jointly supported the yen since 1998. And the United States didn't simply jump in because Washington suddenly started to care about the Japanese yen or suddenly started to care about the BOJ's mission. Instead, there's a much bigger reason for this. Japan is one of the largest holders of US Treasury debt in the world, by far. If Japan needs to raise cash in order to buy the yen and support the yen, one obvious source of cash is of course its foreign asset holdings. And that can include selling US Treasury bonds. But if Japan starts selling treasuries, they're adding more and more supply to an already pressured bond market. More supply, of course, means lower bond prices, and lower bond prices means higher yields, which is exactly what the Treasury wants to prevent. Of course, Japan has another option. It could raise domestic interest rates aggressively, but that creates a different problem. Higher Japanese interest rates makes Japanese assets even more attractive. When you're investing money, it's always a game of comparing one option to another. Anyways, that gives investors another reason to move capital out of US assets and back into Japan, especially Japanese hedge funds, Japanese insurance companies. And that potentially means less demand for US Treasuries and higher yields here at home. So from a distance, Washington is looking at a pretty ugly set of choices. If Japan sells its Treasury holdings, US yields could rise. If Japan raises interest rates aggressively, capital could flow back towards Japan, also putting pressure on US Treasury assets here at home and also putting pressure on interest rates here at home. And that's exactly why Washington stepped in. It was essentially trying to relieve pressure on the yen and the BOJ without creating another problem in the treasury market. And initially it worked. The yen strengthened, again look here at the chart. But that lasted for all about 5 minutes. Obviously an exaggeration, it was a few days, but anyways. So clearly the underlying problem hasn't gone away. The structural issues causing this depreciation in the yen are still at play. And that's what makes this whole situation much more interesting. The US has elevated rates because inflation itself hasn't fully gone away. Those rates put pressure on the yen. Japan then responds to that pressure. And Japan's response can potentially push global bond yields even higher. Which brings us right back to where we started, the US Treasury market. Now, none of this means the United States is about to default on its debt. That's not the argument I'm trying to make at all. But it does suggest that the foundation for a much more difficult fiscal environment is being set right before our eyes. And we don't have to wait for some massive crisis to feel the consequences of all this. We're already seeing them today through higher auto loans, higher business borrowing costs, higher mortgage rates, and for investors, higher long-term yields also changes the math for stocks. And then there's housing. Mortgage rates themselves are stuck near decades highs, and buyers are getting squeezed on monthly payments, while existing homeowners are sitting on 3% mortgage rates and have very little incentive to sell. This has resulted in a housing market that's become incredibly stagnant, incredibly slow, and difficult to transact in. It's something I'm covering in a later video in greater detail, but for now, it's important to know just one thing. Higher treasury yields aren't an abstract concept that exists strictly on a Bloomberg screen. They're affecting all of us today. They affect the financing of the US government, of businesses, and eventually of ordinary citizens, not just in the US, but globally. And that's ultimately why I think the bond market is flashing a warning. The United States isn't running out of buyers for its debt, far from it. Instead, it has a different problem. It's running out of cheap money. The Treasury is trying to manage higher long-term rates by leaning hard on short-term financing. But that makes the government's finances even more sensitive to whatever the Fed does next. And the Fed can't cut too aggressively or at all because inflation could come back at any time. Keeping rates high makes government financing more expensive. Those high US rates put pressure on Japan and of course on the Japanese yen. And if Japan responds by raising rates or selling treasuries, that can feed right back into global bonds. It's all connected, and that begs the final question then. How does all this get solved? What's the end game here? And more importantly, how do you protect your lunch money from all of this? Now, from what I see, the obvious answer, unfortunately, is financial repression through currency debasement and long-term, slow simmering inflation. And this is the only obvious answer to me. Now, what am I doing as a YouTuber, not as a financial advisor, given all this information? I'm increasing my allocation to gold, Bitcoin, and REITs. I don't want to go out and buy properties. I have my own house to deal with. These are things you can't print more of and actually become more valuable the more the government prints. Anyways, that's it for today's episode. If you want to follow this story as it evolves, be sure to like and subscribe. Until next time, protect that lunch money.